Hi and welcome back to the channel. Today we're going off the beaten path slightly and expanding our investment horizon to take a more macroeconomic view of the stock market. We had a couple of requests for a video like this on Patreon and the Discord, and naturally I think it's an important topic to cover and understand. Ordinarily I try not to let macroeconomic factors impact my decisions on investing in good businesses, but there is only so much you can ignore. And even if you're someone who likes to look past the macroeconomic environment, it's essential you know how they work and how they impact the stock market. There are plenty of different macroeconomic factors to consider, but none more rooted to the stock market and its performance in recent times than interest rates. So I've prepared a little presentation here where we'll talk through, hopefully very quickly, exactly how they work, how they affect the stock market, and how the Fed and central banks shape the stock market by manipulating interest rates. Our aim in this video is going to be to explore how this works and why it works. We will then be able to answer the age-old question, do interest rates make stocks cheaper? So firstly, let's look at the historic relationship between rates and the market index. As you can see from this graph that I've got here, there's a distinct inverted relationship between, here we've got the 10-year Treasury rate and the S&P 500, which essentially tracks the US market. Low rates ever since the late 90s, or early 90s, have stimulated economies in a big way, or market in a big way, as you can see, leading to the market cap rising higher and faster than ever before, whilst interest rates were dropping continuously lower than before down here. But it also adds an element of volatility that we can see. So there's drops that are obviously a lot deeper in times of worry, and it's more of a sudden move than it was previously. And it's not like the periods which we can't exactly see here, but the periods before where it would drop down and then take a long time, or it would drop down slowly, it would move with the recession, and then it would trick back up very slowly as well. But as time has gone on, you can see the market's becoming much more of a forward-looking mechanism where it's trying to guess the future, and it's using interest rates as one of its catalysts. Another graph that shows a similar result is this one that measures rates against the PE ratios of the S&P. So if I zoom in a little bit, you can see that the black one is the interest rates, and then the red one is the S&P 500 PE. So when rates are sky high, as we can see here, the PE ratio of the market tends to be down, so equities are getting priced a lot cheaper. And then when the interest rates are relatively low, as we can see here, and definitely since the 90s, then the PE ratios start to get a lot higher than they were historically. So there's a distinct relationship there between not just the performance of the market, but the pricing of the market and interest rates. Lastly, this graph, we see that it shows a bit closer up how reactive the Fed is to markets and how it then shapes the market after their move is made. So for instance, here we see the early 2000s recession. We had it trailing down, and it was trailing down for a good couple of years. So the Fed starts lowering rates to almost zero, and then we see, it stimulates the economy, stimulates markets, they start rising again, but all of a sudden it's rising too quickly, we get the threat of inflation, and they start to raise rates again. And that didn't exactly cause the financial crisis, but it was a catalyst to the markets starting to trick down, and then we had the crash in late 2009, which dropped it. And then we end up dropping the rates in reaction to that again. And we get to, honestly, near zero levels and basically an all-time low, which is supposed to stimulate the economy and markets, and it did so. Once again, we can see this trailing back up. But you see this pattern here where the Fed rates continuously creep down over the years from this cycle reoccurring over and over. And you have to ask yourself, where do we go from here? Into negative territory maybe? And we got close to that, obviously, last year in 2020. So let's tackle the main question that all of this poses, especially in the current market and economic climate. And that is, do low rates really make stocks cheaper? To answer that question, we need to assess what actually happens when rates are low and any repercussions of low rates. And firstly, before we talk about the theoretical point of view or relative cheapness low rates create, let's explore what it does in terms of real economic output, which underpins the stock market performance over time. So to give an overview, the result is a virtuous cycle. And it's important to note this isn't a closed cycle, because obviously after they raise rates and control inflation, we go through a completely different cycle, which is more of a recession or downturn cycle. So it's an open cycle in that sense. But the proximate cause is almost always a recession or economic downturn, and in reaction to this, central banks cut rates, which makes borrowing money cheap and saving money pointless. This in turn stimulates the economy and businesses to spend, and therefore increases the flow of money, which then leads to things like lower unemployment, which then again contributes to economic growth in the form of GDP and other economic growth indicators, because more people have more money to spend and the flow of money is increasing. And it can also mean that things like wages and salaries go up as well, which is a good thing for the economy. And all of this just mentioned makes stocks seem cheap. But cheap is probably the wrong word. A better way to put it is that stocks are set to prosper from the low rate environment because of the increased economic output that it allows for. And if we just add a little bit more detail to that, what stimulates the economic environment and causes businesses to grow? Well, businesses are incentivized by low rates to grow because access to capital is both easy and cheap. So that's the business's incentive. Customers are incentivized to spend a lot more, maybe buy houses or take out loans on things, buy a new car maybe, as borrowing is cheap. And there's also no use in saving because you earn next to no interest. So saving is not incentivized. So customers will go out and spend a lot more money in times where there's low rates. And theoretically, all of this makes stocks more attractive because the businesses have a higher chance of growing cash flows and financing maybe new ventures through, taking on more debt at very cheap rates. And that's where the stock market output comes into it. Running alongside this, we have the fact that low rates make stocks much more attractive relative to other forms of investment, causing an opportunity cost factor, which makes a flight to equities to chase for adequate yields or returns. And while it takes at least 12 months for interest rates to actually have a widespread economic impact from what we just covered earlier, the stock market's response to change is often immediate. And this is because it's a forward-looking mechanism, as we've already covered on this channel before. As well as this, we have bond yields that are low and in many cases below the expected rate of inflation, especially if you're holding a 5 to 10 year bond where the inflation rate can be much more volatile. And we see this happening now. Bond rates on a 10-year basis are about 1.5%. Inflation's going to be at about 2.5%. So you're locking in, theoretically, a real return of minus 1% if inflation is going to be 2.5%. So investors naturally crowd like sheep into equities, which they think will provide the highest return, or at least a higher return than inflation, due to the economy being stimulated. And also we have the risk-free rate or discount rate, which is used for valuing stocks, is reduced to account for what is an acceptable rate of return. And this makes the value of the stocks seem higher today. And if I just go back to the virtuous cycle, what we start to see is this domino effect, like I previously mentioned, where all this end is basically stimulating the economy, and it's great, it's good for stocks, but all of that economic stimulus and spending, as well as the herding to equities, will eventually lead to inflationary pressures due to increased money supply and a demand shift, of which we've already seen and heard about in the current environment today. And we can usually keep track of this using the Consumer Price Index, or CPI, or velocity of money, which measures total spending within a certain time period. And the stock market itself is a good indicator for this, which demonstrates asset price inflation, not necessarily the consumer goods price inflation, that it's just your basic items, but just another form of inflation. However, there's more collateral damage here that we need to assess. And the first one being a currency depreciation risk, of which your investments will be held in. For instance, the dollar. If the dollar starts to depreciate, then the value of your investment starts to depreciate as well, caused by inflation. It also reduces real inflation-adjusted returns on all investments due to inflation eating into purchasing power and the value of money. For instance, if you had a 10% return on equities, but you had 5% inflation, your real return's only 5%. And so back to this, this domino effect we see here. Eventually, inflation occurs and leading to the Fed or central banks having to increase interest rates, or bond rates just rising anyway, as we're starting to see today, to control inflation, or at least get on par with inflation, because no one's going to be buying bonds at rates below the rate of inflation. So rates start to come up and we see the end of this low rate cycle. And then you ask yourself, what happens in high interest rate environments? So what's going to happen then? If stocks have been cheap or theoretically been cheap for that period of time, now we're at the end of that cycle, what happens? Well, if bond yields start to approach near long-term average returns for stocks, which is only around 7 to 9%, then investors may pull out of stocks and decide to hold bonds. After all, they provide a more secure return and naturally are less risky. So why take a gamble on stocks when you have a guaranteed return that matches equities' average return over time? This isn't my thought. This is just obviously the market's thought process. So when interest rates are high, generally economic growth is slow as well. So it's not just that opportunity cost that you're seeing now. Therefore, cash flows of businesses should technically slow as well, which is not good for equities, which obviously cash flow growth underlies the performance of an equity. This generally leads to stock prices either falling or stagnating for a period and can lead to some volatility as well. And actually what's interesting, which we didn't quite cover in the last video I did about rates and the Fed, is that growth stocks or high growth stocks are going to be hurt a lot more in these higher interest rate environments than sort of a value stock. Because if we look at an example where we've got a growth stock that's going to produce, say, 115 million of cash flow over a 10-year period, but the majority of it's going to be in the latter years, and then we compare that to a company that's going to produce 100 million of cash flow, and the majority of that comes, not up front, but it's all spread out evenly over the period, so 10 million every single year of cash flow. In a low interest rate environment, the one that produces slightly more cash flow, but we get it later in the investment period, is going to be worth more. However, when the interest rate or discount rate that you use to value it starts to go up, then the value stock becomes a lot more valuable today, because money in the future at a 9% or 10% discount rate or risk-free rate is a lot less valuable today than money given to us today. So that's just how it works, and that's usually why you see growth stocks tend to get hurt a lot more when there's a scare that interest rates are going to rise. So in summary, do low interest rates make stocks cheap? Well, the theory that low interest rates make stocks cheaper does have grounds. Two factors really. You've got economic growth or business growth, because there's more spending, access to capital is easy, therefore growing your business should be easier. You have asset price inflation as well, which will lift the price of assets and equities. You also have this opportunity cost factor as well, which, using the risk-free rates or comparing what else is out there to get a return, maybe with bonds or even cash, which is going to depreciate over time. You compare that to what equities will give you, which is actually a long-term return of around 8 or 9%. Then there's an opportunity cost factor where it just makes more sense to invest in equities because you're not going to make any money elsewhere. And this means that stocks are better options for investors looking to make a suitable return on their investment. And because of the above, the Fed and central banks can use interest rates to manipulate the stock market. So it's not necessarily that they get cheaper. They, one, get cheaper in relativity, so they're relatively a lot more attractive than others. And also, their future looks a lot brighter, or at least near-term future looks a lot brighter because they're stimulated. So cheap's probably the wrong word, but they definitely are the best option out there in a low-rate environment. But my general thoughts and strategy on it, as seen by the virtuous cycle, it's a short-lived cycle. It can go on for a medium-term period, but it doesn't always play out as and when expected. So it's not an easy guessing game. And I try to avoid thinking about macroeconomic factors such as rates because it prevents you from thinking long-term about individual businesses. But unfortunately, they do matter to a degree. So we need to account for them. We need to understand how they work and how they affect the markets. In almost all environments, I am or will be 100% equities anyway. So I don't use a risk-free rate or cost of capital structure to value stocks. I use my minimum acceptable rate of return, and that doesn't change over time. Also, bonds are unlikely to reach near to a 15% yield, which is my minimum rate of return. So there's no use me really even thinking about shifting a portion of my portfolio to bonds because that's not the return that I'm happy with. And over the long term, stocks outperform all other asset classes as well. So if I'm thinking long term about investing, which I am, I'm best suited to be in equities anyway. And lastly, cash is trash. So I try not to hold cash if I can, although it's always good to have some cash on the side, especially when you're in a choppy environment. But generally, I would not keep my money in cash or even in an interest bank account. I would try and invest as much as I can. And that's about it for this video, guys. Thanks for watching. I know it was a little bit different to our usual stock analysis, individual stock analysis that we do here on this channel, but I thought it would be good to incorporate. We had a few suggestions on Patreon and the Discord to do something like this as well, and I've had it in the comments before, so hopefully you all found it helpful. Hopefully it was quite educational in terms of what happens to the market when these sort of macro events happen. I hope you enjoyed it. If you did, leave a thumbs up. Subscribe to the channel if you haven't already so you can see when the next video goes up. If you have any questions or thoughts on this, then leave a comment below. But until next time, guys, good luck with all your investments.